Hi, this is going to be intense because I'm giving what should be really 3 1-hour lectures. So really, this could be 3 1-hour lectures each. Both the subject of deal sourcing, I could probably talk about for an hour. I could talk about valuation for an hour, and I could talk about due diligence for an hour. But instead, I'm going to try and cram all 3 topics into 1 hour. And these are, this is really where the meat of the lecture series starts, where we're going to be talking about deal sourcing, how to get the deals, valuation. Okay, you've got the deal. Do you agree with the valuation? How do you know that you don't agree with the valuation? What's the meaning of valuation? How do you calculate valuation? And then due diligence. Okay, you've decided now that you agree with the valuation, you sourced the deal. Now going on to due diligence. What are you even supposed to look for? And what things are you going to be looking for to make sure that the investment is the right fit? So yeah, pretty intense, fun, packed set of lectures on 3 of the most important topics in venture capital investment. So let's move. This quote is from Kevin Rose at Google Ventures, and it's a great point to talk about deal sourcing. And he says, I want to find the next Facebook when it's just Mark Zuckerberg. And this is a picture of Mark Zuckerberg in his dorm room in Harvard. I don't know if you've watched the movie called The Social Network, but this is the guy that was acting as Mark Zuckerberg. And yeah, he's saying that he wants to find Facebook, but he wants to source the deal when it's still at this stage, when it's just him, at his computer. And that's really what venture capital is about, right? You don't want to find them when they've already blown. You want to find them at a very early stage, and that's why deal sourcing is so important. So the typical deal sourcing funnel looks a bit like this. You look at about 1,000 investments in a typical year. You prioritize them by the industry investment team. If you have several different industry teams on your in your VC, and even if you're an angel, you shouldn't be investing in every single deal you see. You should be looking at a lot of deals as well and picking the right fit for your expertise. And the right fit for you as an investor. So I think a lot of angels start in this industry by just investing in everything, thinking, oh, this is going to be huge. But I think it's best to look at a lot of deals, get the feel of these deals, do a lot of research yourself, and then prioritize. As an angel, you're usually the investment team, but you can speak to a spouse, for instance, about the investment and really prioritize what you're doing. And then usually in a venture capital firm, about 250 unique investments are discussed at the investment committee. So out of 1,000, only 250 actually get to IC. So by that stage, over 700 are not taken to IC. And then about 30 investments are discussed at the final IC. And only 10 of those 30 will be completed. So if your investment goes to IC, then it means that you've got a pretty good chance. If it gets to the final IC, then you're probably going to get the investment. And then it's 10. So that's how it looks in terms of the typical deal pipeline. So deal sourcing. Now this is a bit of a controversial issue. So I'll read out, what happens, and then I'll talk about what people would like to happen, and maybe what a lot of people feel should happen. So right now, in the venture capital industry worldwide, typical sources of investment opportunity lie embedded within our social networks as venture capitalists and with angel investors. The social fabric woven over time just yields these consistent quality referrals. And actually, peer investors, people that are fellow investors, are the most trusted. This book, again, this is a quote from the book, The Business of Venture Capital. And it says, in any business, relationships are important. But in VC, relationships are make or break. You want to be finding Mark Zuckerberg when he's in that dorm room. And you can only do that through having great networks of relationships. So the biggest source for VC worldwide today is through your network and through referrals from your network. Other sources include incubators, accelerators, angel investors, but the biggest sort of source is through the network. Can anybody think why a lot of people might be complaining about that? I'll tell you why. Because if the biggest source of deals is through the network of people like me, then what happens to Ibrahim from Zamfara? How does he get my number or my email address? So it makes it a very unfair business, because that means that perhaps if you didn't go to a tier 1 uni, so if you're not OAU or Unilag or UI, then where do you get the network from? What if you didn't go to university at all? Then where do you get the network from? And people also say that it's disadvantageous to women. Because a woman, particularly in the African context, isn't rushing out of the office at 5 o'clock because she does not want to go to Quilox or any other nightclub. She's rushing out because she probably has 7 children. So while men probably have a lot more hours to develop their network, they're going for after work drinks, they're talking about deals there. After the after work drinks, they'll go into another bar, they're still talking about deals there. They'll now land Quilox and get home at 2 a.m. What is a married woman doing out of the house? In a typical African, remember, we're not talking about America. This lecture is specific to African VC. What is she doing out of the house at that time? And what will her children even begin to think about her if she's outside the house at that time? They don't care. The children don't care if their dad is out of the house at that time. But what will they think of their mother that left work to be doing after work drinks and did not think that she had children? What will even the husband say that is looking for fresh soup when he comes home from Quilox at 2 a.m.? So I said that I'll talk about what happens. And what happens typically is that most of the deals done in Nigeria today, and most of the deals done across the world, are done by referral. But there's a whole movement in the American venture capital industry that is saying that it's very exclusionary. And in America, it excludes black people. Because black people are, in places, probably didn't go to Stanford or Harvard or Chicago Booth or Yale. They probably went to community universities if they went to universities at all. So what if a black person has an idea? How are they going to meet the venture capitalist? They can't just walk, they don't know anybody that is friends with Peter Thiel or Ben Horowitz or, let me think of another famous venture capital guy, or even Jeff Bezos is now doing venture capital. They have to be introduced to Jeff. So how is it somebody that grew up maybe, on the east side in one of these poorer areas in America, so how is he going to meet Jeff? Well, if a rich person has the same idea, he calls his dad and says, Daddy, I need a meeting with Jeff Bezos. And his dad says, yeah, fine, I'll introduce you. And that's the end of the story. So the fact is, a lot of these ideas, or a lot of these people that we look at as geniuses, right? Actually, when you look at their circumstances, you find out that the whole way that they got their businesses or got their businesses to scale may have been, of course, part genius, but also their background mattered. So Facebook, for instance, started in the hallways of Harvard. The Winklevoss twins called him. First of all, a black person, maybe that grew up in Mississippi, can never get near the Winklevoss twins in the first place. But it was the Winklevoss twins that called Mark Zuckerberg and said, can you design this thing for us? This is what we are thinking of. And Mark Zuckerberg went to go and design it. And they were supposed to be paying him for that design, but Mark decided to just brand it as his own and move forward. But it was in that Harvard environment that he even met the people that had such an idea. And the fact is that there were many social networks. If you remember, MySpace was there, Friendster was there, High Five was there. But what did Facebook have? It was from Harvard. So, because it was from Harvard, the Princeton people said, okay, we must have it as well. And then Yale, then all the top schools had it. And the fact that all these top schools had it meant that all the social climber schools also wanted to have it. And even I can remember when it came to the UK, it was only in Cambridge and Oxford. Then it went to Durham. At that stage, people left my university to go to Durham. They said, we must have this thing, we must get this invite, even if we have to go physically. Because it was already coming to tier 2 schools. And there's a group of universities called the Russell Group of Universities. We're part of it. And we needed to get it even before the other people. So it all comes from a point of privilege. And unless we change our industry, then we'll be missing out on a lot of very, very talented people that are not in the metaphorical Harvards and don't know the metaphorical Winklevoss twins. Because if you are attending University of Maiduguri, the Winklevoss twins will not be there. If you're in a polytechnic somewhere, then there will be no Winklevoss twins for you. So, on one stage, we know that the venture capital industry is run on referrals all over the world. But on the other side, we know that talent is universal. It's opportunity that's not. So there is a venture capital company, I've forgotten what it's called in America, that says the only way that any company can apply to them is through their website. They don't take any referrals. They say even if the owner of the fund says that even if her own mother brings her a referral, she will not take it. It has to go via the website. So these are the new ways that people are trying to include, for the Nigerian context, women, for the Nigerian context, people of a lower social demographic or a different social demographic. Of course, for America, Black people don't have access, and other minority groups don't have as much access because they don't have that access to network. So I've told you how deal sourcing is done, but I've also told you the controversy around deal sourcing. But today, still, around the world, I would still estimate, I don't have any statistics to back this up, but I would say that 99.9% of venture capital deals are all done by referral. But obviously that system gives people that were born into certain kinds of homes, that attended certain kinds of universities, whose parents are certain kinds of people, an advantage over the rest of us. So there are other ways of deal sourcing. A lot of companies are attracted to venture capital companies or angel investors that have a strong brand. I think sales skills and communication functions are also important. So usually the larger venture capital firms have sales departments, marketing departments that actually tell the stories of what they do, and that draws founders to them. And I wrote here, give and it shall be given unto you. Because the more you refer deals to different people within the ecosystem, the more that they will also refer you deals as well. Due diligence. Now you've sourced the deal, whether you got it from Harvard or whether you got it from OAU, or whether you got it from UI, or whether you got it from your Unilag network, or whether you got it from your Zenith Bank network, or whether you got it from your KPMG network, you've sourced the deal. Or whether you got it from another VC, or whether you got it from another angel, you've got the deal now. So what next? You want to start looking into the company, finding out about the company, to try and establish whether it's a fit for you. That's what we call due diligence. And in due diligence, we're looking at three things. We're looking at the jockey, we're looking at the horse, and we're looking at the market. So this is a common question in horse racing, right? That what is it that wins the race? Is it the skill of the jockey, the person riding? Is it the skill of the horse? And there's this whole, like, if you jump into that rabbit hole of horse breeding and how they have to breed certain types of horses together. There's even a lady that I met in London that does aromatherapy. So she lights candles and does smell therapy for racehorses before their races. She does massage for the horses before their races so that they can be distressed and, you know, really focus on the race. So obviously, the people that are doing aromatherapy for the horses, that are doing massage for the horses, that are doing healing ceremonies for the horses to try and get the horse's mind right, believe that it's probably the horse. And then the market as well, the outside market. So the jockey in the case of due diligence is the founder. Is it the founder or the founding team that matter the most? Is it the horse? Is it the product that matters the most? The brilliance of the product, the way the product is crafted? Or is it the market that matters the most? Now, for us personally, we have a market thesis on these things. We believe that a rising tide, it lifts all boats. So one of the things that we scrutinize very carefully is the market. Other people have different theses around this. We still, of course, we look at the team and we look at the product, but we're obsessed with the market. But during due diligence, you look at all three. You look at the jockey or the founder, the founding team. You look at the horse, the product, and you look at the overall market. This quote, I love it, is from Scott Mollier and Chris Brady. They have a fantastic book on M&A. If you're ever doing M&A transactions and you want to become more paranoid about them, then just read their book. Like, it's a very paranoid perspective on M&A, but they have some good quotes, and this is one of them. And they say, in business, there's no such thing as a pleasant surprise, because any surprise indicates a failure of intelligence. So when you're doing due diligence, you need to look for, or try and find out all the information about the company. So hopefully you don't have any surprises down the way. So Jeff Smart, in the Art and Science of Human Capital Valuation, looked at three things that venture capitalists failed to assess when they're investing in companies. One was lack of management experience or operation experience. The second one was the person just couldn't work well with others. And the third, and probably most important thing, was the person couldn't do sales and marketing. So these were the three mistakes that Jeff Smart, when he looked at venture capital funds, and he looked at the people that they had backed in terms of the jockey, in terms of the founder, in terms of the management team, these are the three things that he found that were wrong. In terms of the market, what are you looking in the market? Well, usually you're not looking at this kind of market. It's a fruit and vegetable market. You're looking at the market for the product. And you're looking at the product as it relates to the market. What is the addressable market? Not the total population. The total population that can buy your product. And I have a whole lecture on this thing because I think it's very, very important. So what is the market that can buy? What is the business model? How much money will they be generating per transaction? And then what are the projections as well? And are these projections realistic? This is by Y Combinator, and it's part of their due diligence checklist. So I'll just run through it. As part of your due diligence, you need to look at the business plan. You need to look at any financial statements. You need to look at the certificate of incorporation, and then all minutes written by directors. Intellectual property is a big deal. Do they have patents for anything? And are those patents sort of properly written out? Trademarks, for example, domain names that they use, etc. Any agreements with regard to voting on their board, copies of any agreements at all in charge of their previous their previous cap table, and anybody else who has invested, and what kind of stock agreements they have. Have they given shares to employees? What are the vesting agreements for those things? Material agreements, so any liabilities, any debt that the companies have. You don't want to discover that post due diligence or when you've already invested in the company. Any insurance that they have, any joint ventures, any partnerships, any sales and marketing partnerships, any contracts that they have with other parties, really important to look at. And then disputes. Has anybody sued them? Do they have a serious litigation anywhere? Have they had any legal issues? Look at the employee handbook, for instance. Very, very important in terms of, what is their offer letter, what agreements do they have with their employees, consultants, etc. And that's all I'll say on due diligence. Like I said, it could be a 1-hour lecture, but I think I've given some reading materials along the way that you can go into if you want to dig a bit deeper into this topic. So we've spoken about deal sourcing at the beginning. We've spoken about due diligence and things that you look at during the due diligence process. if you are a member of our collective, then a lot of these things are taken care of. And if you decide to join a collective, that means that really you want a lot of these things done and deals presented to you, as opposed to you going to look for CAC and you going to look for going to the land bank or whatever to go and look for all of the different pieces of documentation. We have our own checklist, which shows all of the things that we've checked before we present a deal to you. But if you're an angel investor or you're thinking about starting a VC fund, these are the things to do. The last topic that I'll be talking about is early stage startup valuation. One of the many things that Babalawos do. A Babalawo in Nigeria means like a magic man, or like some kind of person that can, I guess, access black magic, basically. And this is how they typically look. And the reason why I put them there is because people think that valuation is a form of witchcraft. Somebody just thinks of an idea in their head and says that it's worth $50 million. How do you know that it's worth $50 million? How do you value that idea? How do you value that early stage startup? And it's very difficult to value early stage startups because, like I said, companies on the Nigerian Stock Exchange, the Prescos, the Totals, the ExxonMobils. Okay, ExxonMobil isn't listed actually, but like the companies that are listed on the Nigerian Stock Exchange, you can see the track record, audited accounts, everything is clear, and you know how much that company is worth. But in early stage, you don't know what the company is worth, and that's why people associate it with a bit of black magic. But it's not black magic. I'll explain some of the drivers of valuation. So number one is the growth potential. Number two is the attractiveness of the market. Number three is, do they have a strong management, a strong team, an execution machine? Do they have good capital efficiency? Are there geographic drivers? Are they in several locations? And are they growing in all of those locations? And what are the macroeconomics of the business and the places where the business operates? This is a quote from Lorenzo Carver in his book, Venture Capital Valuation, which I advise you to read. It's a brilliant book. And he says that what you don't know about valuation will cost you money. So there's three standard valuation techniques. And I got this diagram from the Corporate Finance Institute again. So these are the three ways of valuing a business that you're taught in business school. You learn if you're taking CFA or FMVA qualifications, or even in MBAs. Number one is the cost approach. Number two is the market approach. And number three is the discounted cash flow approach. So I'll explain using a house. Now, the home analogy helps me to explain the different valuation techniques. The most expensive area for real estate in Nigeria is a place called Banana Island. So let's say this house was in Banana Island. There's three ways of, if you're a real estate guy and you want to sell this house, there are three ways you could do it. Number one, you could say, I want to use the cost methodology. How much did it cost me to build this house? Let's say you inherited the land and you just built the house. So a house like this will cost you probably about 50 million naira to build. Now, the cost approach says, okay, it cost me 50 million naira to build, so I'm going to sell this house for 60 million naira. That's the cost approach. It's just adding something to the cost that it took you to buy the house. But should you be selling a house in Banana Island for 60 million naira? The cost of building this house, whether you built it in a cotton, whether you built it in Ikorodu, the cost is the same. But the area counts as well, right? You can't just sell this house for 60 million because it cost you 50 million to buy it. But if you're using the cost approach to valuation, then you just, okay, this is how much it costs, so I'm just going to add something on top. The comps, or the market comparison method of valuation, would be looking at other homes in the area. And if you're using the market or comps valuation method for a company, then you'll be looking at other similar companies, like how much are those companies worth at this stage, or how much were those companies worth at this stage that do the similar thing. So if you're looking at the comps approach, you'll be looking at other houses in Banana Island. Mike Adenuga, one of the richest men in Nigeria, lives in Banana Island. What's his name? Abdul Samad lives in Banana Island. So you'll be looking at the cost of a Banana Island home. You go, how much, does this house cost? How much is this house worth? And you might work out that if Mike Adenuga lives beside this house and he paid 1 billion, then maybe you should be charging not 60 million, which is the cost plus. I think you can call it 500 million. Yes, it's in Banana Island. So therefore, you've compared it to the market. You've not compared it to your cost. Now, the third approach to valuation, which is the most common approach that you would see in business schools, and definitely if you're doing an MBA or a master's in finance, is the DCF, the discounted future cash flow. And with this, you'll be looking at how much cash flow will be generated in rent over a certain number of years. So there's a cost approach, there's a market approach, and there's the DCF. Now, I'm going to go into the DCF in a bit more detail. So I have a whole slide on DCF, not because it's relevant to startups, but because it might be relevant if you're investing in an early stage business in a traditional sector. So what you do with the DCF is you calculate the cash flows over a particular period of years and then discount those cash flows to arrive at the current present value. And that's how you calculate the DCF. Now, the reason why, I call it the great unlooking, because even though DCF is used to calculate almost all valuations of companies in the private equity world and in the traditional investing world, it's largely relevant to startups. I'll show you what's probably the most relevant way of calculating valuation in startups. This is a crystal ball, and a crystal ball is, one of those mythical sort of objects that people see that they pretend that they can, well, not pretend, if you believe in it, maybe that's your belief, but people, so let me not use the word pretend, but people say that they can see the future in these crystal balls. And the Harvard early stage startup method is kind of like using a crystal ball to see what you think will happen in the future. And it's by making a lot of assumptions. And I have a slide on the Harvard venture capital method. So the Harvard Business School professor, William Salman, his method of valuation really begins with the end in mind. So this is done by estimating the median time to liquidity, trying to look at the pre-money valuation at the seed round, the ownership at the time of investment, the predicted IRR in several scenarios. So if it does well, if it does okay, and if it does really abysmally, what will be the IRR? And then using those values that you've gotten in these different scenarios, in these different time frames, to now work backwards from the exit and say, okay, right now, what should the value of this company be? And like I said, it's more a science. It's more an art than a science. It's definitely not a scientific methodology. And there are a number of drivers. And if you look in the venture capital world at what's used, then it's usually the market comparison or the Harvard method that I see being used most commonly. Some people would try and use a DCF. I don't think the cost method is applicable at all, but the most commonly I see the Harvard method being used and the market comparison method being used. Last word on valuation. Valuation really, when you're thinking about valuation and you want to maximize exit value, and once you're thinking about those two, the economics, then, with the formulas that I've just taught you and the methodologies that I've just taught you, you can come to a valuation, hopefully, that you as the investor and the founder agree on. Thank you very much.